The market is currently closed. As of the final bell on Friday, December 19, 2025, Virgin Galactic Holdings Inc., trading under the ticker SPCE on the New York Stock Exchange, finished the session at $3.50 USD. This represents a notable intraday gain of 23 cents USD, or a 7.03% increase from the previous close. While a 7% jump in a single session often signals a major catalyst for most blue-chip names, like Apple stock or Nvidia stock, for a high-beta speculative name like Virgin Galactic, this movement is often just another day in the life of a stock that thrives on volatility. However, looking past the surface-level percentage gain reveals an insight that most retail investors are missing right now. The expectation in the broader market is that Virgin Galactic is simply burning through its remaining cash until it hits a wall before the Delta-class ships ever leave the hangar. The reality, however, is that the company has just executed a series of sophisticated financing moves that suggest institutional players are still willing to underwrite this high-risk flight path. If you're tracking this in your individual brokerage or through your Fidelity mobile app, you might have noticed the volume surge accompanying this 7% move. It wasn't just retail traders on a Robinhood app looking for a quick flip. On December 18, 2025, the company signed an indenture for new 9.80% first lien notes due 2028. This move is significant because it shows the company is actively realigning its capital structure to bridge the gap until 2026. Most people see debt and get nervous, especially when the interest rate is nearly 10%. But in the context of a company with almost no current revenue, securing this kind of financing is a vote of confidence in the underlying assets. It creates a curiosity loop for the patient investor. If the company were truly on the brink of insolvency, as some bears suggest, why would Wilmington Savings Fund Society act as a trustee for nearly 10% notes? This suggests a deeper layer of asset-backed security or a strategic valuation that the public market hasn't fully digested yet. Establishing common ground here is easy because almost everyone agrees that Virgin Galactic has been a frustrating hold. Since the retirement of the VSS Unity, the stock has essentially been a placeholder for a future that feels perpetually 2 years away. The general belief is that without a flying ship, there is no business. I want to challenge that by looking at what they're doing with their carrier aircraft, Eve. Just this week, we saw news of a collaboration with Lawrence Livermore National Laboratory. They're looking at using the carrier aircraft as a high-altitude, long-endurance, heavy-lift platform for sensor systems and image capture technology. This shifts the narrative from just space tourism to a dual-use aerospace play. If you're using Interactive Brokers trading tools to look at the sector, you'll see that defense and research contracts are far more stable than $600,000 tickets for thrill seekers. This pivot toward being a carrier platform for government and research use could provide a floor for the valuation that wasn't there 6 months ago. The recent stock movement has been a textbook example of a seesaw motion. Earlier in December, we saw SPCE trading as high as $4.57 before drifting back down to the $3.20 support level. This volatility is exactly why many investors prefer the stability of Schwab Intelligent Portfolios or a more conservative SoFi robo-advisor approach. But for those who engage in self-investing, the technicals here are telling a story of consolidation. We are currently trading in the lower half of the 52-week range, which usually scares off the momentum crowd. However, the RSI is hovering around 36, which is starting to look oversold. When a stock like this hits a 7% gain on a Friday, it often indicates a short covering rally or a quiet accumulation by those who know the production milestones for the Delta class are being met behind the scenes. Speaking of milestones, the business model is currently in a strategic pause phase. This is the hardest part for any investor to stomach. Management has been very clear that they expect the first Delta-class research flight in the summer of 2026, with private flights to follow in the fall. They are currently 90% through the structural parts for the first ship. If you're looking for investment help on a forum or through your Fidelity Wealth Management advisor, they'll likely tell you that the risk here is binary. Either the Delta ships work and they can fly twice a week, or they don't and the company becomes an expensive footnote in aerospace history. But the math on the Delta class is what keeps the bulls interested. We are talking about a ship designed for 8 missions a month. With 125 missions a year, they project $450 million in annual revenue. For a company with a market cap currently sitting under $250 million, that revenue to market cap ratio is what makes people take a second look. Institutional activity has been mixed, but the 20% institutional ownership suggests that there is still a professional base holding on. These aren't just diamond hands from a subreddit. These are funds that understand the aerospace development cycle. The volumes we've seen lately, particularly the 5 to 7 million shares moving daily, show that liquidity is not an issue. This is a highly liquid speculative asset. If you're doing online investing through a Robinhood stock trading account or SoFi active investing, you have to be aware of the expectation versus reality gap in the timelines. The market expects a delay. Any news that confirms they are actually on schedule is treated as a massive positive surprise. That is why the 7% gain today is so interesting. It feels like the market is starting to price in the possibility that they might actually hit that Q3 2026 flight test window. Comment below how many shares of Virgin Galactic you currently hold and what your average cost basis is. I'm curious to see if the community is averaging down or just holding steady through this development year. When we look at the macroeconomic pressures, Virgin Galactic is particularly sensitive to interest rates because of their burn rate. They are burning through roughly $50 million to $60 million a quarter, with a cash position of around $424 million as of the last report. They have a runway that extends into 2026, but it is a tight one. This is why the financing agreements signed on December 18th are so critical. They are buying time. For someone managing their own Fidelity IRAs or looking at investing sites for the next big thing, the question is whether you believe Michael Colglazier can keep the lights on long enough to get the first Delta ship through FAA certification. Unlike Tesla stock, which has a massive manufacturing base and cash flow to lean on, Virgin Galactic is a pure play bet on a future service. The business model is shifting toward a white glove experience. They are planning to reopen sales in the first quarter of 2026. This isn't just about selling more tickets, it's about yield management. The price for a seat is expected to go up from the $600,000 mark. This is a classic luxury play. By limiting supply and increasing price, they can improve their margins even with a lower flight frequency. This is the kind of detail you might find if you're doing deep research on an individual brokerage platform like Interactive Brokers, where you can see the detailed SEC filings. The 8K from earlier this week is 15 pages of legal and financial jargon that boils down to one thing: they are preparing for the long haul. Let's talk about the competition for a second. Blue Origin is the obvious shadow here, but the market for suborbital spaceflight is not a winner-take-all scenario yet. It's more like the early days of aviation. There is room for multiple players, especially if Virgin Galactic can successfully market its spaceport experience in New Mexico and eventually Italy. The feasibility study in Italy is a clever move to diversify their revenue and tap into European government interest. If they can turn the carrier aircraft into a multi-purpose tool for the Department of Defense or Lawrence Livermore Laboratory, they are no longer just a tourism company. They are an aerospace platform company. This is a distinction that self-investing individuals should pay close attention to. The future outlook for SPCE depends almost entirely on the next 6 months of assembly in their Phoenix, Arizona facility. If the fuselage and wing assembly stay on track for completion by the end of this month or early next year, the reality will finally start to catch up with the expectation. Right now, the stock is priced for failure. When a company is trading at a price-to-sales ratio that looks absurd because there are no sales, but has a book value and cash position that almost equal its market cap, you are looking at a stock that the market has given up on. But that is exactly when the most significant moves happen. If you are using Fidelity trading platforms or looking at Robinhood investments, you need to understand that this is not a set-it-and-forget-it stock. This requires active monitoring. The volatility of 69% and a beta of nearly 4 means that even a small piece of good news can send this thing flying, and a small delay can send it back to the $2 range. The current support at $3.20 has remarkably held well despite the broader market skepticism. This suggests that the weak hands have already been shaken out. What's left are the institutional holders and the dedicated retail base that believes in the long-term vision of a commercial space line. The central insights from today's movement are clear. The market is reacting to a combination of successful debt restructuring and a potential